Right, let's jump straight into it. If you're tracking US homebuilder stocks, you really need to understand exactly what is happening right now beneath the surface of the housing market. Today, we are unpacking the August 23, 2026 Fox of Wall Street report on rate sensitivity and inventory trends. We're going to look at the exact data driving builder profitability, dig into the latest earnings from the biggest players, and map out exactly where this market is heading. No fluff, just the critical numbers you need to know. So we've got to start with the elephant in the room, 6.77%. That is the 30-year fixed mortgage rate setting the baseline for affordability as of August 2026. But what's truly interesting isn't just the number itself, it's how it actually functions out there in the real world. You see, mortgage rates affect homebuilders through what's called a non-linear affordability channel. Think about it. Homebuyers don't really care about a house's sticker price as much as they care about their monthly payment. And at 6.77%, those rates are highly restrictive. This is exactly why builder sentiment has been sitting at an incredibly weak 35, well below the neutral 50 level for 16 consecutive months. Builders are literally being forced to actively change the economics of a purchase just to keep buyers in the game. And that leads us to the next massive piece of this puzzle, 485,000. That's the sheer number of new homes sitting for sale at the end of June 2026. Now, while this absolute number is actually down just a bit from a year earlier, the pressure is absolutely not off. Having a massive pool of completed inventory gives buyers choices, which drastically cranks up the pressure on builders to offer incentives. I mean, sure, a builder can protect future volume by delaying new construction, but when you've got hundreds of thousands of completed homes just sitting on the market, well, that quickly turns a sales problem into a major margin problem. Which brings us to a critical absorption variable. That massive inventory, it basically equates to a 9.3-month supply at the current sales rate. That is sitting well above any tight market benchmark. In a healthy, robust market, you'd see a much, much lower figure. Because this number is so elevated right now, we are seeing builders actively moderate their construction. In fact, single-family starts actually fell to an annualized rate of 808,000. That's down nearly 10% month over month. Builders are showing real inventory discipline here. They're keeping permits available, but they are holding off on actually breaking ground. Because, let's face it, a 9.3-month supply just does not justify aggressive new construction right now. So, what does this all mean? Well, all of this data paints a picture of a very specific type of environment. The housing market right now is best described not as supply-free, but as a transaction-constrained market. Let's break down this strange dynamic. On one side, you have existing homeowners who simply refuse to sell because they're locked into older, much cheaper mortgages. So resale inventory is incredibly limited. New construction steps in to fill that supply gap, which leads to that elevated new home inventory we just talked about. But the new buyers stepping up to purchase these new homes are immediately hit with those high 6.77% monthly payments. To bridge that massive gap, builders have to step in with heavy incentives. This gridlock perfectly illustrates how macroeconomic pressure transmits directly into compressed corporate earnings. It's what we call the margin squeeze, and it's a pretty straightforward chain reaction. It starts when higher mortgage rates hit the market, causing buyer affordability to just drop off a cliff. The exact same house suddenly becomes unaffordable, even if the builder hasn't touched the base price. To combat this, builders are forced to add incentives. The report showed that roughly 35% of builders were cutting prices by an average of 6% or buying down rates just to lower the buyer's effective payment. The result of all this? Gross margins take a direct hit. The cost of defending those sales shows up right on the bottom line. Before we drill down into the specific company breakdowns to see exactly how this margin squeeze is playing out in the real world, please take a second to subscribe, like, and share Fox of Wall Street for more stock market analysis. Okay, let's get into the stocks. So how does this margin squeeze actually look for individual companies? Let's look at the biggest player, D.R. Horton, ticker DHI. They are the prime example of the pressure facing mass market builders today. Now, on the surface, their massive scale is an incredible strength. Their third-quarter closings actually increased 4% to nearly 24,000 homes. Not bad, right? But you've got to look under the hood. Their cancellation rate jumped to 20%, up from 17% a year earlier. And because affordability constraints are forcing a much more cautious outlook, management actually had to cut its fiscal year revenue guidance to between $32.5 and $33 billion. It's basically a textbook example of volume holding up while the actual quality of that demand deteriorates. Now, let's pivot over to Lennar, ticker LEN. Lennar shows the margin risk of this environment more clearly than anyone. They delivered over 20,000 homes and generated over 21,000 orders in Q2. Huge numbers. But to achieve that, their gross margin dropped all the way down to 15.6%. That's down from 17.8% the prior year. Why? Because to defend that level of volume, they had to offer incentives that consumed about 12.9% of the transaction. That drove their average sales price down to about $371,000. Lennar proves an absolutely crucial point for investors. Strong unit volume does not guarantee strong profitability when heavy concessions are required to make the math work for the buyer. But hey, the sector isn't uniformly weak across the board. Let's shift gears to PulteGroup, ticker PHM. They're actually showing some really encouraging pockets of resilience. In their second quarter, net new orders increased 6% year over year to over 7,500, giving them an order value of $4.1 billion. Their backlog even rose 2%. However, they're still facing that exact same industry-wide trade-off. Their home sale gross margin came in at 25%, down from 27% a year earlier. So PulteGroup perfectly illustrates that order demand can actually start recovering and showing resilience before profitability fully recovers. And then we have the ultimate contrast, Toll Brothers, ticker TOL. These guys operate in the luxury space, and their data is an absolute revelation on why buyer mix matters so much right now. Their average price is nearly $1 million, $996,400 to be exact. Their affluent customer base is simply way less dependent on mortgage affordability and much less payment sensitive. So even though their overall deliveries declined, their signed contract value actually increased to $2.52 billion, and they maintained a robust 25.6% adjusted gross margin. It just goes to show luxury builders maintain far greater pricing power and margin stability in a rate-constrained environment compared to your typical entry-level builders. So where on earth do these stocks go from here? Let's pit the two main scenarios directly against each other. First, you have the rate cut bull case. This relies on mortgage rates falling materially without the economy slipping into a recession. If rates drop, monthly payments improve, foot traffic rises, and builders can finally stop giving away their margins. But what about the higher for longer bear case? If rates stay stubbornly stuck in that 6.5 to 7% range, demand remains completely payment sensitive. Builders will be trapped. They'll be forced to maintain volume purely by increasing those margin-crushing incentives we talked about, which leaves their earnings highly vulnerable. To actually navigate these scenarios, you can't just look at top-line sales. You need to monitor these 6 key leading indicators. First up, mortgage rates. You gotta watch the 10-year Treasury and 30-year rates for sustained moves, not just one-week dips. Second, new home months of supply. Ask yourself, is supply falling because of stronger sales or just because builders are defensively cutting their starts? Third, incentives. If these are falling alongside stable orders, that is a genuine recovery signal. Fourth, cancellation rates. This is a super underappreciated metric. If cancellations drop, backlog conversion is much safer. Fifth, gross margin. Stabilization here means builders are regaining pricing power. And finally, inventory mix. You really have to separate completed homes, which carry heavy holding costs, from homes under construction and controlled lot. All right, here's your bottom line investor takeaway from this entire explainer. The U.S. homebuilder sector as of August 2026 is entirely in transition. You absolutely cannot make a blind bet on a broad housing rebound right now. Mortgage rates are the dominant constraints, new home inventory is elevated, and incentives are doing all the heavy lifting. But as we saw, D.R. Horton's massive scale, Lennar's volume defense, Pulte's order growth, and Toll Brothers' luxury pricing all offer very different paths through this cycle. Your job as an investor is to connect the macro data to the corporate income statement. Focus heavily on margin durability, inventory discipline, and builder-specific execution. Just a quick reminder, this explainer is for educational and informational purposes only. Home builder stocks are highly sensitive to interest rates and credit conditions. So please, always do your own research before making any investment decisions. I'll leave you with this final thought. As the market waits for the Federal Reserve's next move, are you watching the underlying builder metrics to spot the real recovery, or are you just blindly hoping for a rate cut?